While headline inflation has cooled this year, bond yields continue to grind higher. So what's the market trying to tell us about the future direction of interest rates? Joining us now to discuss, Michael Craig, Head of Asset Allocation at TD Asset Management. Michael, great to have you back on the program.
My pleasure. Great to be here.
So I don't know if this was in a lot of people's playbooks this summer with yields and the bond market grinding higher and grinding to multi-year highs. I think in some, maybe the 10-year and further out, we're back to pre-financial crisis highs. What's going on out there?
Yeah, there's been a little bit of a head scratching. There's been some negative news this month. The U.S. was downgraded. So that certainly wasn't great for sentiment. And more recently, they've announced higher amounts of funding, so they're actually issuing more bonds than what was expected, and so that's putting a bit of pressure. But it's August. A lot of people are on vacation. The speculative community has taken a fairly large short position in Treasury, so that's pushed higher. And I would say that you really aren't going to get a good feel for kind of where we're going to be until about the third week of September, when people are back at their desks and kind of reassessing. At these levels, you are starting to trigger buy programs from large managers moving from equities to debt. And I would be interesting to see where we are in about a month's time once kind of everyone's back at their desks and at work.
You mentioned it's the summer doldrums. You do see the bond yields grinding higher. It gets tongues wagging, of course, because people still need to, fill programming time on different business networks. People start saying, well, if we're 4 on this, why not 6 on a 10-year? I mean, is it realistic that bond yields could move substantially higher from here, absent some massive triggering event? Yeah,
I would look at it two ways. There's a move higher, and then there's the durability of can it stay at that level for any period of time. Can it, 6 seems a bit aggressive, but can 10-year rates move to 5%? I mean, it's possible, but how long can they withstand there? How long can the world kind of function? How long can companies and households get financed at those high rates as people reset their mortgages or look at their variable lines of credit, or companies look to refinance debt, moving from coupons of 3 to 7 or 8? All of a sudden, that starts to affect our demand. As a definition, as the cost of money goes higher, we'll consume less, and that in itself is deflationary. So, look, anything can happen in the near term. Look, there's a limited liquidity right now, so things can move around. But I struggle to see rates staying at a high level for a long period of time without material economic damage being inflicted on the global economy. So, long story short is, for income investors who are looking, not so much for the next quarter, but for longer periods of time, these are fairly attractive income yields that you can garner from fixed income right now.
On the equity side, even though August has been choppy after July was pretty strong in the equity market, they're still holding in, considering how much rates have grinded higher. I mean, there's been a pullback, but nothing too dramatic. I mean, what's the dynamic there?
Well, year-to-date returns are still very, very good. But Europe's pretty much been flat since the spring. When you look at the TSX versus the S&P, very different markets. But the S&P is up, give or take 15% of the year, and TSX is up maybe with dividends, maybe 3 and a bit. That is really an example of how this has been driven by just a handful of stocks. That a lot of good news has been priced in. Now, can they go higher? Absolutely. NVIDIA has earnings tomorrow. AI is all the rage, lots of capital, there's lots of investment going there. But when people start quoting price to sales, and your return isn't sales, it's earnings. You start to use different, people start using different metrics to kind of ascribe value. You should have a bit of pause and think how much of that has already been priced in. So I would say on equities, and again, it's been a tough month for equities. We're going into seasonally a very challenging period. August and September tend to be quite tough for equities. Again, when we get back into work next month, when you look at earnings yields or the price what you pay for a stock versus its earnings versus what you get for cash versus what you can get in fixed income, right now it's very, very tight. The tightest it's been in 20 years, making both cash and fixed income it's more attractive on an earnings perspective than stocks.
We are going to get one event where last summer it turned out to be sort of a big one. Jerome Powell at Jackson Hole. I go back to almost a year because he'll be there at the end of this week, really laying it down, sort of bringing the hammer down, and there was a big reaction. What do you think the message would be from him this time around? I mean, it's been a full year of hiking rates, headline inflation's coming down. What does Powell have to tell people?
I don't think he needs to do a whole lot. I don't think there is the urgency to warn the market about higher rates. The higher rates are already here. When you look at the SOFR, or the old euro-dollar market, the market's pricing in elevated short rates in the U.S. for some time now. We're looking at kind of a terminal rate of 4%. It was 3% a few months ago. I don't think the world's changed that much. So I think financial conditions are already quite tight. Inflation is coming down. You're going to see, just based on the way it's calculated, rental disinflation start to help the inflation numbers. So I mean, longer term, there's a different argument with inflation, but near term, I think that inflationary pressure still continues. So I think he's kind of got what he's wanted. I remember, the Fed's got dual mandate, inflation and maximum employment. Employment's still very strong, but it has started to soften. I don't think this is a time for him to start shifting to the growth narrative, but I don't think there's a lot of value in him doubling down on, that we're going to keep raising rates. And we're kind of at the end of the cycle anyway. Maybe they get one more hike in, maybe not. So I think in many ways he might actually start talking about the success they've had, if anything. And I don't think this is going to be as much of a market event as it was last year.